Most people think a 15,000 monthly SIP will magically grow into 2.85 crores in 25 years. But most people will never get there. Why? Because their portfolio is not designed to last lifelong. Because it is not built to survive real life crashes, temptations, midlife expenses. So today I will show you a research-backed 3-fund framework to build a lifelong portfolio. Just 3 funds, one style, full life. There is something called hope versus reality mismatch. I will show you in this video a real working to improve your SIP calculation. How you can split a 15,000 SIP into 2, or it could be any amount that you like, using the 3-fund portfolio idea for better outcome, like say withdrawing 50 lakhs midlife rather than waiting for the very long term. Watch the full video because 90% of the investors stop midway, and I will explain the reason why they stop their investments also in a minute. First, let me show you a fund that will surprise you in its performance. I'm going to take 2 funds from the same fund house, and by looking at their return history, you will immediately understand why most investors behave strangely. This is again not a recommendation. I am using these funds only to illustrate this concept. Look at Mirage Asset Hybrid Equity Fund. This fund has only 70% exposure into equity. Now what are the returns? In the last 1 year, this fund has delivered 5.4%. 3-year annualized return is 14%. Now let us compare this with its counterpart from the same fund house, the Mirage Asset Flexi Cap Fund, which is a pure equity, that is 100% invested in equity. Its 1-year return is 6.6%, and that is very comparable to the hybrid fund of 5.4%, despite having full equity exposure. The 3-year return is 15%, almost the very same as the hybrid funds, 14%. Now let's broaden this discussion and look at the category average of these funds. The aggressive hybrid equity funds category, that is the category average, gave 1-year return of 4.32%, and the flexi cap category's average in the same 1 year was just 1.9%, actually a bit lower. But over 3 years, aggressive hybrid delivered 15.46%, while flexi cap delivered 16.82%. Again, they are very comparable. Now, what is the point here I'm trying to make? Think about it. You have one fund with 70% equity exposure, another with 100% equity exposure, yet their long-term returns are nearly about the same. The results are very glaring, and there are 2 key insights that come up. When you see only 1-year returns like 5%, 6%, you think the SIP is not working. They panic and investors stop investing. But when you zoom out to a 3-year, the difference vanishes. And the hybrid fund with less equity is almost matching pure equity funds performance. What does this mean? It means the problem is not with SIP. It is not with compounding. It is not with the market. The problem is that people focus on the wrong time horizon. They look at 1-year number instead of 15 years or 20 years of compounding. And because of this short-term lens, they exit exactly when they should be investing more and continuing. So here is another big insight. You don't need to take high risk to get market level returns. Whenever investors reach out to me, almost everyone has one question in mind. So they ask, can you refer a very high risk fund? And I know that they are asking this with very good intention. They want to achieve their family's financial goals faster. They want the best for their children, etc. But the hard truth is, taking higher returns does not guarantee higher returns. Data proves this. A simple 70-30 portfolio, that is 70% equity, 30% debt, delivered almost the same long-term results as a 100% equity portfolio. This is proven by actual numbers. Now let me show you 10-year averages of these two. Flexi cap category with full 100% equity delivered 13.6% annualized return. The aggressive hybrid category with lower equity, lower risk gave 12.46% annualized return. So the difference is about 1% per year. You might think it's a big 1%, or you might say, oh, it's only 1%. So here is the illusion that traps most investors. I call it the Mirage Gap because 1% looks very attractive in the long term, like water in a desert that people keep chasing after. But in reality, by chasing that 1%, most investors actually end up losing much more because they cannot stick with the volatility of the 100% equity portfolio. Think about it this way. Markets go up and down every day. In fact, if you have 250 days, trading days in a year, in a flat year, approximately 125 days market goes up and 125 days market goes down. Half the time you feel good and half the time you feel bad. Now, most people only look up the up days when they dream of making returns. But the truth is, your wealth is also built or destroyed on equally same number of down days. Over the long run, there may be more up days than down days, and that is how obviously the market goes up. But I hope you get the point. This is where the two fund portfolio will help you. They fall less on down days, and that's why over a 10-year, their final returns look up almost identical to a 100% equity portfolio. At the same time, it takes half the risk or thereabouts. So when people actually tell me that they want to take high risk funds, what I explain is this: don't chase Mirage Gap. It's an illusion. Chasing it is only going to exhaust you, shake your confidence, and make you quit SIP midway. Instead, play the long game with a very balanced approach, and that's how you actually reach your financial goals. And almost nobody does that. That's the gap between hope and reality. And that is why we need to flip the plan. Instead of chasing an imaginary number, let us design a lifelong portfolio, one that will actually survive market crashes, midlife expenses, retirement, children education, and the math is surprisingly simple. A 15,000 SIP or multiples based on your individual life situation, structured the right way, just across 3 funds can give you both midlife liquidity and retirement wealth. Now let me show you how exactly to build this lifelong portfolio. It is a 3 fund portfolio that balances between equity and debt. Your exact mix depends on your risk tolerance. It could be 70-30, 60-40, 80-20. Most people may not have heard about risk score. So here is a request: drop a comment with your risk score. If you don't know what it is, just write "not done" and I will share a free risk profiler in the pinned comment. So now let's assume your risk profile suggests a 70-30 portfolio. That means one fund would be the 100% equity fund, up to 70% of your portfolio for growth. The second fund is a debt fund, up to 30% of your portfolio for stability, cash flow, and liquidity. Or it could be debt plus a commodity like gold. But there is also a third fund option, which can be part of this equity bucket itself. This could be a smart alpha fund or an international fund. Why? Because no single country leads at all the time. The US and India often top the charts, but there are years when Europe, they outperform. So diversifying across global countries reduces the risk of depending on one country. For example, in 2013, India was up 7%. In the same year, many global markets did much better than India. Plus, the US dollar itself appreciated 6x in 40 years. That is 5% annually. So Indian investors who took USD exposure earned much higher returns due to both the market growing up and the currency appreciation. So this 3 fund structure makes investing journey much more survivable. You stay invested during bad years, you capture the growth in the good years, and in the end, you actually reach those big numbers. Remember that 15,000 SIP dream we talked about earlier in this video. Let's break into something more realistic. 2 parallel SIPs, because in real life, people need money mid-term because life events like kids' educations, home loans, emergencies, career shifts. So instead of a single SIP, think of it as 2 or more parallel SIPs. It's called mental accounting. 10,000 SIP for 15 years, about 50 lakhs for midlife needs. I'm assuming 12% expected annualized return. Of course, nobody knows what the market will offer. So you must understand this with this caveat very clear. We run a parallel SIP for 5,000 rupees for 25 years. That will fetch you 95 lakhs in retirement corpus, again at 12%, expected annualized return only. Together, that's about 1.5 crores. And importantly, it is usable when you actually need it. It is not locked for the entire life in theory. However, inflation eats the purchasing power. So you must always plan with inflation adjusted numbers. Now, there are emotional and behavioral reasons why people stop SIPs, stop investing. Job loss, fear during crashes, chasing new funds, loss aversion. Hence, investing is not just a math formula. Compounding does not fail, but behavior does. So, the real question is, do you have the right portfolio design that allows you to stay invested for life? That's where the lifelong 3-fund plan comes in. Please consider liking this video. If you enjoyed the content, consider sharing it with your friends and subscribing to this channel.